Hi, my name is Scott Gibson with Beneath the Surface. I'm here with John Kaiser of Kaiser Research. John, thanks for being with us.
Thanks, Scott. It's good to be here.
Yeah, I wanted to get your take. We're here in Vancouver at the Cambridge House Show. I wanted to get your take going forward over the summer and the near term of the overall general markets.
Well, the overall general markets are just doing fine. You know, New York, S&P are going up. The resource sector, however, is doing the exact opposite. We've just been through a capitulation phase, and now we're wondering, are we, like in 1999, facing a long, dreary sideways period, or are we going to see a correction? And the key to a correction is going to have to be gold.
And what's your take on that? Which way do you think it goes?
Well, I have a sort of a view on gold where I see long-term structural demand for gold growing in conjunction with the growing prosperity of the world, to a large degree driven by the emerging economies such as India, China, Brazil, and so on. What happened recently was a smackdown of the apocalyptic gold bug narrative, which is all premised on horrible things happening in the world, some sort of depression coming, hyperinflation, and so on. And that narrative, I think, is dead. Right now we're going through a story correction. And a thing that's behind this is, I think there's a purge of the ETF gold. And that's an interesting story if you want to talk about that.
Yeah, please share with our viewers.
Goldman Sachs first came out with this 1350 prediction, and then they piled a whole bunch of gold in the ETF market and also in the COMEX market. Since then, they've come up with 1250 and more recently at 1100. At the same time as gold went down, we saw massive physical buying demand surge around the world. There isn't much physical around. And I suspect that what's happening is that the bullion bankers are short physical gold, probably leased from the central banks, and they're trying to cover it, but they can't really buy it in the physical market. But the ETFs, and contrary to all those conspiracy guys, the gold actually is there. So what they've literally done is an extraction of gold from the ETF, because the ETF is held by all these hedge funds who are all like playing the short-term apocalyptic gold bug narrative. And when this went down, they had to exit. Since December, 10 million ounces have been extracted from the 45 million in the SPDR. And the way Goldman is ratcheting up ever lower or ratcheting down the targets for gold, I can tell they're desperate to get the flush out happening because they smell a sharp reversal in the gold price.
And that's a massive amount of gold to be sucked out of the market.
No, it's not really. I mean, it's a drop in the bucket. There's 175,000 tons out there, and what is it, 150 tons inside the ETF? It's a tiny amount.
Okay.
But tiny short positions in the financial system of this nature can be troublesome. So I think once this is solved, gold can run. And of course, the poor gold producers and the developers, and that they were all roadkill. And there's some signs that big players have been buying the gold that all these funds are being forced, the gold companies, that funds are being forced to dump because of the redemption runs created by the whole mantra about gold is dead, America's reviving, all these problems that gold is a hedge against are disappearing. And I think that's just the wrong narrative. I think America reviving, Japan getting back in the game, Europe finally reversing its austerity strategy, and China avoiding an implosion. All of that is bullish for gold, because I think precious and base metals, their future is now twinned. If we go into a global depression, those metals are going to all go down. If we go back into a global expansion, they're all going to go up and demand will be strong for them.
And that's your take. We're going into a global expansion. Metals are going to move up. Do you have an idea or a feeling of timing? Is that a short term? Is it a long term? We've heard here in the Vancouver conference 6 months to 18 months until things really start to turn around.
That depends on whether my speculation about the rationale for the smackdown is correct. If it's correct, I think we could see a sharp reversal Because if all the hedge fund money is extracted from the ETFs and it's just normal people with their retirement plans owning the ETF and they can't suck any more gold out of it, then you will see people start buying the ETF again. And if central bank buying actually kicks in, I mean, central bank buying is only about 675 tons that have been bought by central banks since 2007. However, that breaks down into about 2,500 tons bought by these emerging market economies and about 1,800 tons or so sold by all these past empires, Germany, France, the IMF, all these countries that are no longer players in the future. So there is if you look in the details, there is a distinct trend by the world's future, soaking up gold. And I think if China were to come out tomorrow and report that they actually own 2,000 tons rather than just 1,054, and that extra amount would be equivalent to all their production since they last reported in 2009, that would put them up to 80 million ounces and about fifth place, vying with Italy and France, who aren't going to buy any more gold. And that would, I think, be a spark where everybody says, uh-oh, China hasn't reported for 4 years. Now they come out and tell us that we have actually accumulated this gold. Then there is a panic buying in the central banks. They say, we got to get this stuff. Because they buy physical gold, not ETF gold, you'll see the physical correct upwards, and then the ETF will chase that.
But why would they do that if they're, as most people believe, still trying to accumulate more gold? Why would they want to show their hand at this point?
Well, one of the problems is the private sector, which owns 82% of all gold that exists, has almost an insatiable appetite for gold that seems to go up as the price goes down. Unfortunately, that's not how it works in our juniors, because when it goes down, the appetite disappears, even though there are better bargains out there. So I think there's going to be a turning point where they realize if you want to soak up a lot of extra gold, it's going to have to be at a higher price. And we've had 30 years of post-1980 gold production, 2.3 billion ounces added to the 3.2 billion that existed in 1980, and that low-hanging fruit is all gone. And costs have risen. This sort of 30-year bear market we had for gold, that was a structural response to the fact that we had such a monumental real price increase from 1971 to 1980. That was 400%. Right now, the real price increase, if you use inflation-adjusted term, is a piddly 20%. That's nothing. So nominally, gold looks like it's up 400, 500%, but in cost terms, it's not a real gain. And when the market understands that, if it wants to keep adding gold, another 2 billion ounces over the next 15 years, it's going to have to be at a higher price, because at current levels, there's not going to be much mined.
And what's your take going forward, medium to long term, on gold?
I think gold by 2030, China, the balance of power in the world will be very different from what it is today. It will no longer be unilaterally the United States. The US dollar will not be the single reserve currency. We're in a slow motion trend towards that new reality. The only exception would be if China implodes upon itself, which could happen if the United States tips itself into a depression, which would take down all these emerging market economies. That's sort of the negative scenario. So I see gold, like even with my model, if all the gold that exists stays at 10% of global GDP, and we have sort of the IMF growth projections become reality, a range of $1,400 to $1,700 over the next 3 years is completely plausible. And if the anxiety increases to say 12-14%, that actually ratchets up to like $1,700, $2,100. Throw in some geopolitical stressor, like something going wrong with North Korea or in the Middle East, and then you have a blast through $2,000. Right now, the equivalent peak for 1980, when gold hit 850 in these percentage of GDP terms, would be $3,400. So you could see a intense spike of gold to some number like that. It wouldn't be sustainable there. It would come back down. But when it comes back down, it would be to a level that's much more interesting than where it is now. It would be at a real price level, and that would bail out this sector. But if we don't have this happening, we are dealing with a grinding 6 to 18 month period, and because there is so little capital left in the system and the needs for capital are much higher than they've ever been, there is a risk of extinction of like 500 companies, and because of structural changes in the whole financial industry, the way brokers operate, the way money gets raised, I could see even the junior sector disappearing because the infrastructure is now idled and human infrastructure has to feed itself, and it may just disappear. So we may see the death of the Canadian junior resource industry go the way of the Spokane Stock Exchange.
Could very well go that way. Well, there's two opinions coming from you depending on the way the markets play out and the way gold plays out.
Yeah, so my own strategy is now's the time to go in there and pick and choose, buy the ounce or pound in the ground companies where the economic study numbers look reasonably reliable and are relatively recent, and just place your bets that the turnaround in these metal prices will be sooner than later. And the other one is look for exploration companies, because if we're stuck in a sideways market, the only things that are going to go up are new discoveries, like we saw with Colorado, where a 16-cent bottom fish with $7 million in the treasury pulls a great hole, and all of a sudden they're at $1.50 within a space of like 2 weeks. With, if you do some outcome visualization, you could see a $5 to $10 reward in the next 12 months because of the nature of this type of play and what it takes to drill off this type of system.
Are you a shareholder of Colorado Research?
No, I am not.
No, I'm not either at this
Fortunately.
point. What other companies do you like right now?
What other companies? Well, for example, if you're bearish on China's ability to keep mining molybdenum and tungsten at the current rates, which is higher than it's ever been, then you would look at the Hunter Dickinson Group's Northcliffe Resources, which have just completed a feasibility study for the Sisson deposit in New Brunswick, a good jurisdiction. Yes, it's high capex of $500 million, but all you need is some troubles in say China, and here's actually where things going wrong in China actually would be good for this company, because the Chinese supply of tungsten and moly would probably decline, and then you would see soaring APT tungsten and moly prices, and then the wisdom of having 9% of the world tungsten supply coming from New Brunswick would be seen, and you'd see the money flow into that.
What about on the precious metal side?
Well, I'll give you an advance warning on one I've been doing homework on. Midas Gold. This was a high flyer, came out at $3 to $5, raised a lot of money, has completed a PEA. They have 5 million ounces they're going to produce. They also have an antimony byproduct. And antimony is another one of these metals that comes 85% from China, and there's some potential new uses that could ramp up demand. And it's a strategic metal that's on the Department of Defense's critical list of things that we ought to stockpile. So Idaho is kind of like people perceive it as a permitting risk area, but the project area basically was the biggest tungsten producer during World War II, so it's a designated mining area carved out of this wilderness area, and the wisdom of permitting this, I mean, there's many reasons to say don't block this. It's still going to take 3 to 5 years because that's the process. But at 70 cents where this is trading now, they just sold a 1.7% NSR to Franco-Nevada for $15 million. They got enough money to deliver a pre-feasibility study over the next year. It's a great option on my kind of hopes that gold's going to spike back to $2,000 and put the juniors back in the game, because a stock like that would be on everybody's instant buy list once this negative downtrend in gold reverses.
Yeah, well, I've heard other groups that have done research around the world looking for assets, and that shows up in their top 5 list. So it's one of the, you haven't recommended that one yet, though.
No, that's why I'm hoping you're not going to air this too soon.
It might be a while, so there may be still some opportunity.
Good.
Yes.
I'm planning to put that one out soon, and course, everybody else has already recommended, and there is an institution suffering redemption runs, which has been a heavy seller.
Right,
and once
right.
that's gone, this stock will probably rebound sharply. So,
And I hear insiders are buying it too. They're taking the cross off of the funds that are selling their positions. So I've been watching it as well. It's definitely on my radar. Thanks very much for being with us. Really appreciate your comments on the markets, on gold and silver, and where metals might be going, and a couple of companies that you like.
You're welcome, and thank you, Scott.
Thanks, John. Again, that's John Kaiser, Kaiser Research. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.